Dear listeners, welcome to this presentation of the NDC Action Project and the Climate Finance Training Kit. This presentation is about the identification of national sources of finance and financial structuring. During this presentation, we'll talk about the scope of financial structuring, the scope of the use of national funds and leveraging other sources of finance. Then we will talk briefly about the mapping of sources of finance at the national level. Then we'll take you through some of the operational instruments or the scope of action for governments and which financial instruments can be used and other instruments as well. And we'll round off with an overview of financial engineering, some general aspects of financial engineering, and also provide some examples of financial structuring and financial mechanisms that have been created for the purpose of leveraging investments for climate action and NDC implementation or other climate action implementation. So in a traditional private sector terminology, when we talk about feasibility or projects that are feasible, we usually refer to projects that are technically and politically feasible. While viability or projects that are viable, those are the projects that are feasible, but also that under realistic assumptions produce acceptable returns on the investment as determined by the investor itself. But a project is bankable or financeable only if those returns are produced with a sufficient level of certainty as perceived by third-party funders, which are typically the banks, and that's why we talk about bankability. And if the banks are basically convinced that the project can repay the debt. Therefore, the majority of financial engineering, when we do this structuring and create financial mechanisms, is also for accommodate the concerns of the banks or the financiers. This might seem unfair, but it's not necessarily as unfair as it seems, because traditionally the banks provide most of the total financing for projects or other financiers that provide debt finance, including those projects which are related to climate. And they usually provide this finance upfront, so at the beginning when the risk is highest and all the forecasts are basically, and our assumptions are to be put to the test. So the banks, they depend on future cash flows to repay the loans, and unless cash flows are as expected, there is a risk of default and they lose the money. On the other hand, if the cash flow is higher than expected, the banks don't really have an additional advantage and they only still receive the interest of the loans and not the benefits as the project owners do. So therefore, banks take a considerable amount of risks. And the banks are also usually the closest ally of the private sector. So if the financial participation of the private sector in the mitigation action is crucial, which it is in most cases, in most policy interventions, usually in one way or another involves private sector participation. So it is basically the financial engineering's scope to provide conditions that allow the private sector and its banking partners to participate and benefit together from the intervention and investment. So financial engineering is not about convincing the banks against their investment principles and to take risks that they wouldn't otherwise have done to invest in sustainability. And it's not really about replacing banks with other financiers, even though we can look for other sources of finance. But it's basically about designing financing to allow the private sector and its banking partners to invest profitably in commercial proposals with the benefits of reducing emissions. Now, this is mostly the case for mitigation, not always the case for adaptation, but this is a general rule for those actions where sort of positive cash flows can be expected. Of course, for certain adaptation actions, that don't generate revenues or where you cannot monetize the benefits of the implementation, the conditions are different, and the banks usually don't play necessarily a prominent role, and grants can be expected. But in general, when we talk about financial engineering and bringing projects from feasibility to bankability, is about creating the conditions that make the investment profitable. So in this slide, I introduce the concept of leveraging, which is basically about increasing the amount of finance available for a given intervention or measure. And when we talk about leveraging, is about one initial investor or financiers that puts down a certain amount of money and commitment or implement a certain type of action, which stimulates other financiers to invest and mobilize their resources for the same intervention. So increasing the amount of finance available for a given purpose. And leveraging climate finance for national climate action and NDC implementation usually also involves a financier or a stakeholder or institution in a leading role. When we talk about NDC action development, the leading financier or stakeholder is typically a domestic public institution. And we're not necessarily only talking about investments or what we usually perceive as investments, but also other type of actions. We can be mobilizing national resources through a revision of government budgets, which is direct investments. But it could also be by showing a willingness to regulate the private sector, both through hard or softer measures, to basically steer the market in the preferred direction. With the NDC actions and their initiatives, which usually rest on the public sector, it is logical that the public sector should go first in order to inspire private sector investment. This can be done either by incentivizing low carbon and climate resilient investments, or also by disincentivizing carbon intensive and maladaptation practices. So a first step is to basically identify the possible options for redirecting funds or sources of cross-subsidization as well in national budgets. And that is an exercise in itself. But when we do that, any freed up cash flows or investment capital from the national budgets can be used to leverage international public finance, which is mainly donor finance. This doesn't mean that the two sources of public funding, so the national and donor funding, should be deployed in the same manner. So the two can be deployed where the special characteristics are most valuable. So, for example, international donor funding has usually a distinct advantage for risk cover, and particularly if foreign private investment is also being sought for. On the other side, host country strength is in the government's regulatory power and the power to rearrange the national budget in support of specific purposes. So structuring the available finance from these two sources can create the investment conditions and options that are attractive for the local private sector. Eventually, possibly even sufficiently attractive for the foreign private investors, who in most cases face higher investment risk than the local competitors. If you recall from an earlier presentation about the flows and sources of climate finance, we usually see that most of the climate finance invested in climate action in country comes from within the country itself. So based on these, there is a sort of right order of leveraging. So as the national private sector has limited leveraging power over the foreign public donor, the national public sector should start its leveraging efforts by presenting its policy ideas to international donors before it then starts deploying its national financing capacity with the aim of securing private sector initiative. So starting with a review of the national public sources of finance that can be diverted or invested this commitment is crucial to attract international public finance for climate action. And with these two combined, we can create the necessary conditions to steer the market towards low carbon and climate resilient actions, utilizing the national private finance sources. And when the sort of market is ongoing and the concept is proven, then usually the interest from international private sector can be expected, but only then. So, as mentioned, the first step is to map the national sources of finance that can be freed up or utilized for the given scope and purpose. And so we need to, first of all, map all the public stakeholders. We have a look at budgets. We have a look at the available sources of finance that can be redirected and utilized. We need to map what is already ongoing in the given sector where we want to implement our actions, which programs are in place, which national sources of funding is already provided, can it be utilized better, merged, reutilized. We need to identify the instruments, the financial instruments which are currently employed, and also regulatory instruments. See if we can redesign these to be more effective. We need to identify the current financing sources, if there are both national and international, and the relevant stakeholders, so the national development banks, how is the private sector involved, and so forth. And we need to consider the role for the private sector, if any. In some cases, public sector investment don't necessarily need to involve the private sector directly, in case the national budget provides all the investment. It does so for certain critical infrastructure, for example. So when we have done our mapping and we have a full understanding of the current situation, the instruments used, the available sources, what are the budgets, and still having a focus on the public finance, so on the sort of government side, we then have a range of instruments that we can use to make the changes in the market that we want to make. Starting from the top left, we have environmental fiscal reform, and here it's basically regulation, and the government can, through taxation and fees, disincentivize and incentivize practices. So disincentivize carbon intensive and non-climate resilient practices, which would then divert investments from the private sector, ideally, towards climate resilient and low carbon practices. At the same time, then basically additional revenues are generated through these taxes, which can then be invested in the measures that we are trying to implement and create the incentive for the private sector. There are also other instruments like loans and soft loans, which can be provided from the public sector. Government bonds can be used to raise capital for investment in certain climate actions. Dedicated credit lines can be established. So credit lines, we talked about financial instruments earlier, but basically loans that are dedicated for a certain specific type of action that can be offered at preferential rates. And then there are risk cover instruments like guarantees that can be provided to enable or the access to finance for the private sector or lower the cost of finance for the private sector. And then we have grants, of course. When we look at the operational instruments, there are some recurrent instruments like the grants, but there are also, the government implements a wide range of activities, and through its daily operations, there is also room for intervention through the purchase contracts for goods and services. There can be room for making some contract conditions that are low carbon or that induce climate resilience as well. there are, if budgets are available, there is a potential for additional payments like feed-in tariffs for the usual example, renewable energy that is fed into the grid, a premium that can be paid for that. Other public procurement guidelines, which when government is basically the largest procurer of goods and services in countries, so the guidelines for procurement can also make sure that the activities that the government is involved in when it procures services and goods are or contribute to low carbon development and climate resilience. Then, of course, the whole taxation issues. So the disincentivization and incentives towards different practices. So tax credits, import tax credits, for instance, for green technologies can be provided, higher taxes for practices which are deemed as carbon intensive and don't contribute to climate resilience or work against climate resilience. Then there is a variable or accelerated depreciation, which has an impact on basically the taxes paid by the private sector, which can also be used. There can be a removal of subsidies for certain goods or processes or practices. Prime example is fossil fuel subsidies, dedicated loan schemes, and guarantee schemes, again, already mentioned. So I mentioned the concept financial engineering earlier, and this figure might look quite complex, but it's really just about bringing projects from feasibility to bankability. So even though we might have a concept, technology, or project that is deemed feasible from a technical perspective, the financial engineering is about making sure that the finance is structured in such a way to make the project bankable. And usually that involves structuring the finance from a wide range of potential sources and using, in many cases, different financial instruments and operational instruments to make a project bankable. So the assumption here is that what we intend to do, the measure we plan to implement, being low carbon development related or adaptation related, is not happening by itself under the current market conditions, and therefore it needs a push. And this push is created by the conditions that you can create by designing a financial mechanism that will allow the private sector and its banking partners to invest. And this figure just basically shows a variety of sources on the left and a host government on the right, different instruments, financial and operational, that can be used to direct them to the private sector to leverage private sector investments, which can then go into, in this example here, into a special purpose vehicle, the SPV, a structure specifically generated for making the implementation of a certain measure or activity. So now that we have a general understanding of the concept of financial engineering, we'll here provide some examples from various projects on how financial engineering was made and financial mechanisms proposed for the implementation of different types of climate action. Here, the example is from a project in Honduras. It was actually a project for the development of a livestock nationally appropriate mitigation action in Honduras and a low carbon development strategy for the livestock sector in Nicaragua, which is at the time implemented through a grant from the Nordic Climate Facility. And here the UNEP CCC and the Tropical Agricultural Research and Higher Education Center, CATI, were the implementing agencies, which also provided some in-kind contributions. And the project identified certain practices for the implementation of the National Appropriate Mitigation Actions, or NAMAs. It was the implementation of silvopastoral systems, including rotation and division of paddocks, the introduction of biodigesters, and the production and application of organic fertilizers. And at the same time, the grant provided through its activities a substantial proportion of capacity building to farmers. Training was provided on how to implement more climate-friendly technologies and systems. And the project also made cost-benefit calculations that shows that the investment in the practices could actually be cost-effective and generate positive cash flows. The positive cash flows would be provided by increased productivity. And even though the investment in these practices would require high operational and maintenance costs in addition to the capital costs, it was deemed that the returns on the investment would be positive. So we had established a feasibility, but why weren't these practices applied on a large scale? So some critical barriers for the implementation of these practices were identified through an analysis of barriers that we did in interaction with the local stakeholders. There was, first of all, lack of capacities, so low level of knowledge and technical ability to implement some of these practices. And there was also a lack of administrative management of farms and financial knowledge and understanding to basically assess costs, access investment capital, and do the investment. And from the financial perspective, there was a lack of access to credit for investment in biodigesters and the materials for implementing the other practices. So the investments and training costs required for the implementation of the NAMA were calculated, and we had a total of 551 million to implement, so for the investments to implement the practices. And of course, you cannot expect a grant of this size, but also because the farmers will achieve a positive return on their investments, they are the ones that can be expected to invest in these practices. There was also then a sort of capacity building training component that was identified to the tune of 21+ million. And through consultations with the various stakeholders, a sort of proposal for a financial mechanism was developed. And in this case, the farmers represented the private sector that needs to make the investment in the new technology. But here, a financial mechanism was needed to overcome the barriers that were identified. So the training needs and the access to low-cost credit. So this is why it is necessary to involve other actors, a wide range of actors. So looking both at the public sector, the private sector, and in this case also international financiers. And in the case of Honduras, the following mechanism was designed to overcome the identified capacity and financial barrier. So the Directorate of Agricultural Science and Technology in Honduras, DICTA, they already had an agricultural technology transfer program for the improvement of productive capacities and to develop skills of producers. And this could cover 32% of the technical assistance and training. So the mapping of national sources of finance that I referred to earlier in the presentation. And this national contribution was to the tune of 1.3 million US dollars. And it was very important to show a sort of national buy-in and that this was an action that was a priority for the country. The NAMA was also connected to other existing initiatives, such as the National Rural Extension Program, supported by the university and the University of Zamorano in Honduras, but also the Texas Technical University and the National Autonomous University of Honduras, and also the National Program for Reactivation of the Honduran Agri-Food Sector, and dairy consulting. And this program had a budget of 2.1 million US dollars approximately. So looking at not only the national sources of finance that were for the training, but also other sources that could be used to sort of fit into the overall structure and financial mechanism. And in addition, through the Sustainable Management of Productive Landscapes project, so a separate project, the Ministry of Environment had already made investment in field schools, expecting the project to establish between 150 to 200 schools to be able to reach 6,000 farmers or producers. And the costs of establishing these schools were estimated at around 20 million US dollars and could be coordinated with the NAMA to provide the needed training and capacity buildings to farmers. So this showed basically the streams of capital from national sources that went into the initiatives and was coordinated with the NAMA. So including this funding as a national contribution to the NAMA gave it a good chance of leveraging further funding through international sources of finance. So the NAMA was intended to provide initial international funding to be able to offer preferential loans to farmers in the first 5 years. And the anticipation is that the funding for the NAMA would then stimulate the private sector and the market to be self-sustainable over time. So after these initial 5 years, both the farmers and the banking sector would have learned enough from this experience to both accept the provision of loans to farmers, but also being capable of implementing these practices. So the NAMA basically proposed to provide 30% of the funding in preferential loans or guarantees to leverage national sources of funding to the tune of 58 million plus US dollars, enabling the provision of large scale provision of large scale loans to farmers. Of the 21 plus million needed for capacity building activities, 20 million approximately would already come from national sources through existing programs that would then be used to invest in the capacity building for the NAMA, and then an additional 1.5 million would be sought as grant through international climate finance sources. So this is just an overview of how the national sources of finance were structured to provide sort of the national buy-in and provide the climate rationale for why the additional climate finance was needed. International finance was also not only looked from the Green Climate Fund, but also the IDB. It was envisioned that the Central American Bank for Economic Integration would then channel these funds through the Ministry of Agriculture and Livestock that would then be directed to DICTA, so the Directorate of Science and Technology for Agriculture and Livestock, to provide the technical assistance while providing the funds directly to the national financial institutions, which would in this case be the National Bank for Agricultural Development and the Honduran Bank for Production and Housing. And they would then be the entities that would provide loans to the producers or farmers. And over time, then the local banking sector was expected to then gain enough confidence in the program and also be able to provide additional private finance for investments in these practices. This last example is from Mauritius, and the financial mechanism here is about the establishment of a de-risking facility for energy performance contracting. And the starting situation is that investments in energy efficiency by the private sector usually doesn't happen because they spend their limited capital available in their core business. And this even though the energy audits that are available show that these investments usually have a payback time of 3 to 4 years. As well, the public sector is restricted for making investments in energy efficiency because the public institutions that use the different public buildings, they are limited by their annual budgets. So those specific funds are allocated in the national budget for investments in energy efficiency, and therefore energy efficiency is usually not achieved either by the private or public sector. At the same time, you have energy service companies, or ESCOs, which could invest on clients' behalf and be repaid through the energy savings achieved. But here banks do not lend money to ESCOs because the machinery and equipment and the measures that they implement are in facilities owned by a third party, so being a private sector company or a public building. So they don't accept the investments, the machinery and equipment invested in as collateral. And so therefore the ESCO's financial reach is constrained to their own available equity that they can invest. They can only invest in a limited amount of projects at a time. The concept here is to provide a guarantee that can cover up to 80% of loans provided to ESCOs, enabling the banking sector to provide finance for investments in energy performance contracting, what we call the contract modality under which ESCOs operate with. And do that through the establishment of a revolving guarantee fund. Here, the initial seed capital sought is 15.6 million euros, which would enable the National Guarantee Fund to gear, so be willing to provide guarantees of an additional 7.8 million, so 15.6 sought from outside as a form of guarantee capital. We have numbers on the average energy performance contract investment, around $300,000, and there is a range of assumptions that have been tested also for their strengths, so changing these parameters to see how bankable is this financial mechanism under certain different conditions. So the sensitivity analysis that was presented during one of the previous presentations. And based on these calculations and the amount of projects that we expect over time, which is in the top table, so the different amount of ESCO project that will be facilitated by the provision of loans. In the top table, it's the number of years first and the number of projects implemented in the different years. We have a number of average investment and average energy savings per project, which gives us a number of average financial savings per project. Based on these calculations, we see that the initial national sources of finance or gearing that would be provided by the national authorities, coupled with these 15.6 billion sought from international climate finance sources, would then leverage 27.6 million euros of private sector investments over the first 5.5 years of project implementation, if the number of projects assumed up here is implemented, and more than 100 million euros over the lifetime of the project, basically. We also have an estimated mitigation potential of the activity that is illustrated here by the graph. And for the structure of the financial mechanism, we would have an international climate finance source here, the Mitigation Action Facility, which would provide the seed capital for the guarantee fund of 15.6 million euros. There's a request for technical assistance of 828 plus 829,000 euros for training, capacity building, the design of ESCO supporting regulation in the country, etc. In Mauritius, an entity called Capital Asset Management, which has the capacity and history of providing guarantees, would be the fund manager, which provide guarantees to national commercial banks, which would then in in their turn, provide loans to the ESCOs up to 80%. The ESCOs would be required to provide 20% in equity, but they would still be able to access finance from banks and expand on their project portfolio, enabling the country to basically fast track the implementation of energy efficiency measures in the country, in their industrial facilities and public buildings. So that was it for this presentation. I hope you have a clear understanding of a sort of approach to take when looking at national sources of finance and how to approach the financial structuring for your interventions and projects to bring a concept from feasibility towards bankability. Thank you very much for listening.